Joining us on the CPI print is Indranil, Chief Economist, Yes Bank. Hi Indranil, welcome to Russia. Indranil, the first cut of CPI print is out, and it seems has cooled off, from a month before February. Also, it is well within the tolerance of RBI. Firstly, how are you reading into it, and then we'll speak about the numbers that came in on the Wall Street front and how it's likely to impact us.
Yeah, well, obviously the numbers that came out are at a sub percent level, so which is a very positive sign. Having said that, if I really look at the internals in terms of, for example, the momentum in terms of the food inflation, the momentum continues to be relatively quite strong, which is at around 0.2 compared to the 0.1 that we saw last time. The cooling of the inflation may have been also to a certain extent due to the reduction in petrol, diesel, and LPG prices in the month of March. So that's one reason why the inflation could have cooled off. Some of the other reasons is the relative sort of lowering of momentum in terms of the protein commodities, meat, egg, fish, eggs. So that's another space that had actually come down. The core momentum also has been lower, though because of the gold increase, there has been an increase in the momentum of the personal sector segment of the inflation. So that I think is the overall sort of behavior of inflation into this month.
Right, but Indranil, like you mentioned, food inflation still remains at elevated levels, and also, the easing of inflation could be attributed to probably the easing in petrol and diesel prices. Is this likely to sustain? Firstly,
Well, it's a
are we
very
likely to maintain those levels? Yeah.
so obviously, because of the higher base of the previous year, we are likely to see a downward trajectory of the inflation and even a sub 4 number by around the July. But this obviously factors in a normal monsoon. So the headline sort of indications of the monsoon is definitely of a normal year in terms of the monsoon, but there are a lot of internals go into monsoon, which is basically the timeliness, the spread, apart from the extent of the precipitation that we are expecting. So that's something that we'll have to look forward to. Secondly, let us not forget about the tomato price shock of the previous year, which is basically a seasonal factor that has not found a very significant input into the current inflation trajectory that most of us are building. So that's the other sort of downside that can happen in terms of getting surprised relatively to the higher side on inflation. And I think as RBI also has sort of very clearly pointed out that the second half of the inflation, second half of the financial year inflation on an average basis is likely to be higher than the first half, mostly on account of waning of the base effect. So that's another thing that we need to sort of factor in before we can talk about sustainability of inflation on the lower side. Last but not the least, the crude oil prices are on the higher side, but the government is holding on to the pump head prices. So whether there could be a revision on the higher side post the elections is something that needs to be factored in. Commodity prices are on the higher side, and currency also has relatively depreciated. And some pass-through effects could be seen from the WPI side to the CPI side, given that demand continues to be relatively strong in the economy. So these are a basket of things, some uncertainties that we are looking forward to in terms of factoring in how the inflation trajectory pans out.
Right. And what does it spell for the rate cuts there, Neil? Because, just last week we saw the US CPI numbers that came in hotter than expected. And of course, it dashed all the hopes of the three rate cuts or the sooner three rate cuts that, the people, the markets were expecting. How does it, impact Indian markets and RBI's decision post the numbers that have come out from India's CPI? And of course, the experts have been saying that the rate cuts will follow once the US starts cutting rates. How is that likely to pan out?
So that's also our view, in the sense that we are expecting the RBI not to move before the US Fed. The possible reason is that interest differential between India and US is pretty narrow, and the currency being where it is, the RBI would possibly not want to risk lowering rates ahead of the US and facing some depreciation pressures. So that's one part of this. Now, in terms of the US, I think you were right, whereby even though the US policy, the last policy maintained 75 basis in terms of the dot plot, subsequent inflation data, labor market data has led to some amount of toning down of expectations to what extent the US Federal Reserve would be able to cut. And there are sort of estimates all the way from only one cut to two cuts. Some people are also possibly looking at continuing to look at three cuts. So it's an evolving story. The more important factor is that we think June is not possibly the right time for the Fed to cut. It could get delayed, which necessarily means that the RBI's rate cutting cycle possibly may not be earlier than August. And if you really ask me, in terms of the core expectations that we have at this point in time, possibly it's likely to get delayed as much as in the October. And more importantly, I think the extent of uncertainties and the moving pieces that you have on inflation will probably prevent the RBI from providing any advance signals for inflation or for rate cuts, by which I mean to say that the stance change may happen only possibly in the policy where they actually decided to cut rates, not ahead of that.
All right, Indranil, on that note, the rate cuts could be delayed as long as the month of October. On that note, we will let you go. Thank you so much for joining us then.
If you like this video, then like, share and subscribe to ET Now.